Karl Schamotta is back with us as chief market strategist at Corpay. Don't want to put ourselves out of work here by not getting people excited about every inflation print.
Of course.
But it does feel like we've seen a lot of waffling in the markets just based on every new data point or every new comment when there is a long-term trend that everybody's staying pretty consistent on.
Yeah, long-term inflation expectations have remained very well anchored. We're not seeing a lot of volatility there, but there is considerable uncertainty about how fast we get there. And this all has to do with, firstly, the pace of disinflation in the economy, but then secondly, that estimate of where neutral rates should ultimately wind up, right? Or where rates should hit from a terminal perspective, right? So the question at this point here in Canada especially is the Bank of Canada going to cut rates and then move them all the way down to sort of an accommodative level to help spur growth in the economy? Or are we going to see central banks just kind of step back, cut very gradually, and try to normalize rates, right? And I think this is so important to where we go in the future, right? Because if we look at what a lot of investor playbooks are, they're basically anticipating a reversion to what we had prior to the pandemic, which was, a decade and a half of unusually interventionist central bank policy, an ongoing commitment to preventing market volatility, a continuing desire to push rates really low. What we may see coming out of this is a situation in which central banks just try to bring rates back to the long-term historical normal, which is, maybe 3 or 4%, right? They're not going to try to push rates all the way down. And so I think where we're having all these course adjustments isn't just the idea that inflation is proceeding at a sort of halting pace, but also that we don't really know what central banks are trying to achieve at the end of the day here.
So let me ask two questions based on that. One's on the economy and one's on the markets. I guess let's start with the economy, because higher interest rates, it is, yes, it's intangible, but it's somewhat palpable. Like, people they're not exuberant in this country right now, I would say, in this higher interest rate environment, right? So it has been restrictive.
Yes.
And I guess the question becomes, if getting back to some kind of normalization is, a more ideal scenario for central bankers, that would mean that we weather these higher interest rates better than some had feared. If they're going to be quite aggressive in cutting rates, I assume that leads to the R word, recession, real worries about ripple effects with the housing market, all that kind of stuff.
Yeah, I guess I would suggest that we are seeing the impact of higher rates, no question. Economic growth in Canada is slowing. We have very weak aggregate demand. In the near term, we do think that the fact that we had rate expectations come down so much back in October and November, even December, that's going to translate into more borrowing, more home buying, more spending in the Canadian economy. But the fact that those rates are relatively elevated, in comparison with pre-pandemic levels, means that sort of gravitational force on the economy is still in play, right? So the question here isn't whether, the central bank tries to cut in the face of a recession, but how far, right? They will cut if we do face recessionary conditions. They will try to provide, some sort of stimulus. But at the end of the day, if they don't go back to where we were prior to the pandemic, then that is a force that reworks how the Canadian economy functions. Because, for decades, we just borrowed more and spent more.
And then briefly on the market side, is there a case to be made that even though I know the market was anticipating, both in Canada and the U.S., quite a reversal in rates, and people are constantly fine-tuning that, is there a case to be made that if the economy is weathering relatively well through all of this and rates don't go down as much as people previously thought, but the economy's not collapsing, that's actually not a horrible situation for investors?
Not at all. I do think that's a sustainable situation. That takes some of the volatility out of the mix. However, in that environment, we still have a lot of renewals in the mortgage market. We still have a long-term, drag coming from higher borrowing costs. And so that means that, any market gains are not, they shouldn't be that extreme, right? We should not be seeing the sort of bubblicious behavior that we've seen in recent years, right? So this is a cycle that could play out in a very nice, favorable way. But the reality is that it's going to be bumpy, as we sort of course adjust our way through it.